Hi everyone, it's Andrew Johns here. Really excited to have another market update for you. It's been a while. Today our eyes are all on the bond market. This video is going to cover a few things. One, we're going to talk about the bond market volatility, what's going on in that space today. We're going to explain to you why you need to be paying attention to this, why you should care, and most importantly, how this is going to affect everyday Canadians. Okay, so let's get into this. Bond markets have been reeling. I've been saying for the better part of a year that this economic impact of the COVID-19 pandemic is going to be profound and it's going to be very costly. I just didn't know exactly how it was going to play out. We still don't know for sure, but we're starting to see some signs. How the global shutdown will affect investors and consumers alike is still a bit of an untold story. But if COVID-19's first chapter was titled A Global Pandemic and Chapter 2 was Operation Vaccine, Chapter 3 would be titled All Eyes on Credit. And this is how it goes. The debt or bond markets never really get the same attention as asset classes like stocks and gold. It's not as sexy as Bitcoin. It doesn't generally account for much on most investors' portfolio allocations today. See, most bonds are bought and held by pension funds, mutual funds, insurance companies. But the bond market is huge. In fact, the International Capital Markets Association estimates that the global bond market has a notional value of about $128 trillion, of which is about 68% government debt and 32% corporate debt. Just to provide some context, the combined market value of all publicly listed companies across the globe is about half that number at $85 trillion. To even put further context to it, as a comparison, combined market value of gold on the planet is $9 trillion. And I talked about Bitcoin earlier. Well, let this sink in. The bond market is 150 times the size of Bitcoin, yet you barely ever hear about it on the front page news like you do with the cryptocurrency. Just as compelling is the rate at which bond issuance have been increasing. Take a look at this. There's been a huge explosion of new bond offerings across the globe in 2020. They've accounted for more bond issuances by governments and corporations in the year 2020 than all of 2010, 2011, 2012, 2013, 2014 combined. Now, you simply cannot issue debt forever at an exponential rate like we've seen in 2020 and expect things to remain normal. Unfortunately, while the mainstream media continues to focus on rising cases of COVID, vaccine rollout, and Kanye West breakup with Kim Kardashian, the story investors and mortgage holders should be focused on is what's happening in the bond market today. Let me show you. We're going to talk about the yield curve first. Now, the yield curve is commonly referred to as the constant maturity treasury rate. In short, what this is this is the rate at which everything else in the world of interest rates is priced. This is what the government of Canada or the United States government pays on their bonds from terms of 6 months all the way out to 30 years. And it's really important because things like GICs, mortgage rates, and what banks pay you on your cash, again, is all related to where these rates stand. So let's take a look at these US and Canadian yield curves. Starting with the US yield curve. As you can see from this graph, the rate an investor earns on US bonds has increased dramatically on the long end of the curve, up here. But this doesn't affect most individual investors, because I mentioned earlier, it's sovereign wealth funds and pension fund managers, insurance companies who actually buy these bonds. But take a look at this yield, because it's a foreshadow of things to potentially come. To analyze this more, let's look at some individual bonds, and we'll start with the United States. 5-year Treasury bonds. You can see here that the yield on these bonds have doubled from 40 basis points to 80 basis points. Now, in absolute terms, it's still far less than 1%, of course, but it's a very compelling, a little bit alarming number. 30-year US Treasury bonds have also seen a very material increase, 50 basis points in the last 30 days. Now, let's go to Canada. Sticking on the theme of 30-year Treasury bonds, we see something very similar to what's happened in the US. And if we look at it from a pricing perspective, this is where it gets really astonishing. A 16% drop in price. Now imagine this. Imagine if you did buy a 30-year Government of Canada bond at an annual yield of 1.25%, and 60 days later, your investments drop by 16% in value. You're going to be waiting years just to recover your principal. So this is when I've told clients before, you don't think you can lose money in bonds? Hold on, strap on that seatbelt, because you're about to see why. Now, leaving the best for last, take a look at the 5-year Government of Canada bond rates. 5-year Treasury bonds have had an increase of 125% in the last 30 days, yet they're still yielding less than 1%. And as a result, we've seen a modest drop of 2.5% in their price. Now look, a 2.5% drop in price on any asset doesn't seem like much, especially when you compare it to equities. But when your annual rate of return is less than 1%, you're basically holding on to that bond until it matures. And when it's a 5-year term at that rate, do you know you're only making 4.75% in aggregate over 5 years? That's why we haven't had our clients buying bonds for a better part of a decade. And it's why I've been pounding the table that our clients stay out of these bonds and stay out of bond funds until we see much higher interest rates. So let's bring this all back to explain how this affects you. The reason we highlighted this data point on a 5-year Government of Canada bond rate is, drumroll please, mortgages. Here's a few facts for you. The average mortgage debt in Canada today is $190,000. I know it might not seem like much for us living here in Vancouver or in Toronto, but that's a big number. And in fact, it's a 12% increase year over year, and it's the highest on record in our country. It's so much so that 68% of all debt held by Canadians is held through their mortgage. And then if you add in the home equity lines of credit, that number jumps to 78%. 16% of mortgages last year went into deferral. A third of those people still haven't even resumed payments. We've seen a 20% increase in mortgage originations due to higher housing prices and refinancings. Now, where are these refinancings going? Well, take a look at this really fascinating point. The average credit card debt in 2020 plummeted under COVID, dropping from $3,000 to $2,500, about a 17% drop. Now ask yourself, why would credit card debt decline when we're at all-time high unemployment levels during a global pandemic? Well, first of all, we have to remember that the wealthy Canadians don't carry credit card debt, and the poor Canadians don't have credit cards that can't qualify. It's the middle-class Canadians who have. And those middle-class Canadians a lot of them got CERB checks last year, and a lot of them have also used their homes to refinance and take that debt and move it from their credit card to their mortgages. Now, tactically, this is a good move because typically credit card debts are up here and mortgage rates are down here. The most important part, though, is are those Canadians letting those credit card debts creep back up? 63% of mortgages are also uninsured in Canada. This adds a lot more risk onto the big banks. We're going to keep our eyes on this as well. I want to bring this all back to one really critical data point. This is the spread graph on the difference between a 5-year mortgage rate and a 5-year Government of Canada bond yield. Now, as you can see, the spread has widened dramatically. This is the highest level it's ever been in the last 10 years. What does this mean? It means the banks think that lending money to you as a mortgage holder is becoming very risky. It makes sense because these government programs that have been launched last year to help COVID-19 can't continue forever. I believe some of the darkest days economically are in front of us here. And this graph seems to show that. We're at a 4.5% spread when the average of the last decade has been 3.5%. And that's just right now. How bad is it going to get? To finish, if mortgage holders refinanced in 2020, they got a screaming deal. But those sub 2% rates, they've come and gone. As the bond market begins its upward trend now, mortgage rates will follow. And if the Canadian banks see an added risk of defaults, those mortgage rates could accelerate far faster when the bond rates increased by. And forget about the Bank of Canada, Federal Reserve, and them telling you they're not raising interest rates. As we saw from the days of Thatcher and Reagan, sometimes they don't have a choice. So my advice to you, go look at your mortgage, see what your options are, call your banker or your mortgage broker, and maybe consider locking in your mortgage now if you've got a variable rate mortgage, because I don't think it's going to get any better. Thanks for tuning in. Make sure you subscribe to our channel so you get more of these updates. Hope you enjoyed this. We'll chat with you soon.